Joining us now is Citi's global head of commodities, Layton. Max, welcome to you. What would that imply for WTI prices?
Yeah, so we think Brent prices can hit $70 in the next few days, and TI prices, WTI, up to around $66, $67.
And $67 would mean we've gone from, we were below 55. So this is a big rebound. It's not terribly catastrophic yet, but you could hear the president, the public adjusting to the reality of paying less than, I think the national average is like $2.83 at the pump. It's going to start going higher. It could crack above $3 again. So with that in the background, what do you think is going to be in the foreground as it relates to the conflict in Iran?
I think this it could potentially all happen very quickly, right? Very quickly. I mean, that's certainly in the president's interest with respect to his desire for lower oil prices. He will want the geopolitical risk premium, which has been risen by around $5 over the last few days. We think can rise at least another $5 over the next few days, especially if there's military action or these protests continue. Also, I mean, Russia-Ukraine is not just the Iran risk. Russia-Ukraine risks are elevated, and we're having a lot of supply disruptions in terms of exports from a number of different countries. So there's a few bullish factors now, but it's quite plausible that a lot of these things pass by with the winter passing and with some kind of resolution in Iran.
Right. What would you say people in the market are anticipating in terms of potential supply disruptions from Iran? Because what's the supply situation there as it is?
Yeah, I mean, as it is, it looks like it's fine. So the regions that are the big or near the big oil producers, the oil production doesn't look like there's been, well, from what we can tell, significant protests in those areas. So there's no obvious signs of disruption at this point, which is why it's all premium. But for reference, back in the middle of last year, the oil price Brent went from the low 60s all the way up to $77. And there was practically no disruption then either. So that was a $15, $16 move higher in the oil price on no disruption, pretty much all premium, all geopolitical risk premium. And so this is a fraction of that so far.
Jeff Curry was on last week, really to his credit, before this kind of started to take off again. And he warned, he said, he's not so convinced that the market is that oversupplied this year, which was one of the reasons why we've seen prices down so much. He said, yeah, there's extra storage on floating barrels, but it's not like you're seeing inventories overflowing everywhere. Could you give me your take on what you think the supply situation is both right now and for the remainder of the year?
Of course, yeah. No, look, I agree with him. A big part of the reason we've shifted our view, so, Citi, we've been bearish for the last couple of years. With myself as kind of head of commodity research, we've been bearish from $80 down to $60. But in the last 3, 4, 5 months, we've shifted to, an above consensus, neutral to only very slightly bearish view, which has actually been one of the more bullish views, if not the most bullish view out there on crude oil. And that's been all about the uncertainty. Part of that's about the uncertainty around exactly what the demand level is. There's a huge variation both on the demand and the supply side across not just the street, but the consultants, third parties. There's a big debate about exactly what the level of demand is, level of supply is, and there's a big range on the estimates. And that just takes away some of the certainty around the balances. And that's why oil's in a show me moment. Show me the surplus. There has been something of a surplus. Most of it's getting absorbed by China, though, and most of it's being impacted by supply disruption. So between China stockpiling and supply disruption, there isn't that much of a surplus at the moment. Having said that, all this can change very quickly. So obviously, geopolitical risk premium can completely collapse if there was some kind of more certainty around Iran. You could have a Russia-Ukraine deal at some point. Perhaps it's our base case, actually, that happens around the summer of this year. And all of a sudden, you're in a world there where you've got pressure for OPEC to cut production again. So this can change rapidly.